All right, so today we're going to be looking here at the Exam 2 review for Accounting 2301. And this is going to cover the information found in chapters 4, 5, and 6 of our McGraw Hill textbook. So chapter 4, primarily dealing with merchandising accounts, various computations, things like shipping terms. Chapter 5, primarily dealing with inventory, things like Fifo and Lifo. And then chapter 6, primarily dealing with petty cash, bank reconciliations, things along those lines, just to give you a rough outline of what we're going to be going through in this video. And with that done, we can go ahead and hop right into our first problem. Now, I'll tell you right now, I give a question typically similar to this on my second exam. And this question goes one of two ways for most students. Students either do really, really, really well on this question, or they do really terribly. And there's very few people that do anywhere in the middle. And what determines how you're going to do on this problem is the process that you use to solve this problem. If you use the picture that I'm about to draw, and that I strongly recommend, and if you have me in class, you'll see me draw this and hear me talk about this frequently, most likely. If you use this picture, you'll do really well in this problem. It won't be too bad. You'll be able to easily sort through and figure out what you need. You'll get down to the end and you'll go, wow, that was pretty easy and straightforward. If you try to do this with just some formulas that you've memorized, I think you're going to struggle quite a bit on this problem. And I say that from years of teaching this class and watching students struggle who refuse to draw the picture. If you draw the picture, you'll probably get all the points on this problem. If you don't, you'll get about 20% of the points on this problem. By and large, that's what typically happens. So here we go. Here's the picture we want to draw. And your textbook has a fantastic image that I'm going to do my best to recreate here. It has 4 squares and a rectangle. And so it looks like this. If you draw this picture, I think you will be good. So here we go. What we're going to do now, we're going to go ahead, we're going to hop over. I'm going to start drawing us some lines here. So these top 2 squares feed into this rectangle. And you'll take the sum of those 2 squares, and that'll give you the total right here. Then this total will be split into these 2 boxes. And of course, the sum of those 2 squares will come back to the total in the rectangle. So everything should be tying down. Now, what goes in this first box is my beginning inventory. What goes in this second box, this is my net purchases. Now, whatever I began with, plus whatever I bought, that's the stuff that I have available. This is what it's called cost of goods. So COG, cost of goods, available is the A for sale. Cost of goods available for sale. That's what we have. That's what we're dealing with right there. Now, for the next piece, we say, well, what happens at the end of the period? Well, I either sold the stuff that I had available. And if I sold that, that cost will land in cost of goods sold on the income statement. And so if you want to remind yourself, that goes on the income statement. Or maybe I didn't sell everything. So that'll stay in ending inventory on the balance sheet. And those are my only options. Now, if you have this picture drawn out, now it's just a matter of finding the information we need and dropping it in the boxes. So I'm going to change my color of my pen here just to make this a little bit easier to see what's going on. But in this case, they tell us for the merchandiser only compute goods available for sale and cost of goods sold and gross profit. And then, of course, compute net income for each company. Now, why can we only do this for the merchandiser? Well, the merchandiser sells goods, right? My other company in this case, my service company, they don't have inventory. So they can't have things like cost of goods sold. It doesn't make sense. They don't have goods available for sale. They don't have inventory. Now, in this case, for my computation of goods available for sale, you say, well, what is that? Oh, that's this box right here. Well, what information do I need for that? My beginning inventory, $5,000. So I'll come in, drop that $5,000 right there. Net purchases, $3,900. Put that right here. And we can see that this is $8,900. Now, for the next piece, I say, well, now give me cost of goods sold. So now we're solving for this right here. Well, to solve for that, I go, well, okay, my combined information of ending inventory and cost of goods sold better come back to be that $8,900. So what I can do is look and see, okay, well, we didn't sell 1,700. So we've got 1,700 in ending inventory. And now I can just solve 8,900 minus 1,700 is 7,200. That is my cost of goods sold. Then for my gross profit, of course, we remember the formula for gross profit is just net sales minus cost of goods sold, and that equals gross profit. So in this case, we look and we see that our net sales were 9,500. We just computed our cost of goods sold as being 7,200. And so we know then our gross profit is that difference, $2,300. This is how easy this problem can be if you use the picture. Now, with that said, we're going to go ahead and I'll type this out just so you can see how this should look if you're writing along with me. Beginning inventory, this will then be the 5,000. Beginning inventory, 5,000. Then here, of course, this is plus our net purchases, and that was 3,900, giving us, in this case, goods available for sale, 8,900. And at this point, I'm going to go ahead and erase my picture just so we can very easily see what we're typing over here. But you can see that using that picture is going to make your life substantially easier on the exam. So we'll go ahead, we'll get us a nice double underline there, get us a nice single underline here. And now for the cost of goods sold, you can do this in one step, but just so you see how this is all tied together, I'm going to go ahead and repeat all of these three lines. So I'm just going to pull that down. But of course, at this point, this won't be a double underline anymore because, well, that's not the end. So we'll go ahead and get rid of that. That gives us our goods available for sale. Now we'll take out our ending inventory. And of course, we saw that as 1,700. And this gives us our cost of goods sold. Now it looks like we might have picked up a couple extra lines when I did that copy and paste a minute ago of 7,200. 7,200. And this is our final answer for cost of goods sold. So we'll go ahead, get that double underline, and get rid of those extra lines. Now, what we're going to see at this point is, and I hope the logic here is making sense to you with what we're doing, because you look at this and you say, well, how much can I sell? Well, I can only sell what I have, and what I have, it consists of two parts, either the stuff I began with or the stuff I bought during the period. That gets me the goods available for sale. That was our first step. Now, at that point, only two possible things can happen with my inventory in this class. We either sell the inventory or we don't sell the inventory. If we don't sell the inventory, we still have it, meaning it's an ending inventory. That's what this is. If, however, we did not sell, or if we did sell the inventory, then of course that goes to cost of goods sold, and that's the difference. That's that 7,200. Now at this point, our gross profit, we're just going to take our net sales. That was $9,500. We're going to subtract out our cost of goods sold. And if you want, you can say that's from to. That's what we just did a second ago. That's $7,200. Giving us a total here of $2,300. And this is our gross profit. Now, for our next piece, we're going to go ahead and we're going to look at the computation of net income. Now, we're going to take it from the top just to give you a full picture of the overall differences between merchandising and service companies. But of course, you could just start here at gross profit if you wanted. So what I'm going to do, just to make that abundantly clear, is I'm literally going to copy that information and paste it right on in. I think that probably gave us two extra lines, so we'll take those out, and if we need to add something back in a minute, we can. Now, what that'll do, that gets us back down to our gross profit line. And now the only thing left that we've got to take out are those other expenses. Now, in this case, they don't give us titles for those specifically, but they do tell me that's a total of $1,450. So $1,450. And now that we've done our gross profit less our expenses, this gets us to our net income of $850. And I understand this is ignoring income taxes. Yes, this problem doesn't give us an income tax rate or anything along those lines, so we don't really have an option. but to ignore income taxes. Now, truthfully, this should have been income before taxes, then we'd have an income tax expense line, then we'd have net income typically. But in this case, we didn't have that information provided, so we have to assume we're in this nice world of no taxes, which makes our lives a little bit easier, and we can just take that difference and call that net income. Now, for our service company, this is a lot easier because look how much work this just took for the merchandiser. For the service company, I only need two things. I need my revenues and I need my expenses. And luckily, those two things were given to me exactly as such. So we've got revenues less expenses, and that'll give us net income. So our revenues, if we look back up, are $14,000. And so just to show that, here's where that's from. And then our expenses were actually the line right above that. So our expenses are right here. And then our revenues, I'll do them in blue, are right here. So we've got our revenues of 14, our expenses of 12.5. So we'll go ahead, we'll take that out. And that will get us to net income of $1,500. $1,500. And so at this point, we are done with this problem. And like I say, unfortunately, students typically really struggle with this problem on the test. I would say on average, students in the class earn about 50% of the points on this problem. And it stems from the fact that a lot of students will not draw the picture that we used at the beginning to get us through those first three sections. I'm not sure why. We want to try to just do this all by memorizing some formula. That's fine. And I mean, really, that's all the picture is too. But most of us are visual learners. And if we can see the picture, our lives are made much easier. And so if you will draw the picture for that and for any other problems where we have helpful pictures, and exam 2 is rife with them, then it will make your life much simpler. If you don't want to draw the pictures, then you have to start memorizing a bunch of formulas. And that's just a lot harder for most people, right? We've got a finite amount of space to store stuff in our heads, and wasting it on memorizing formulas that we don't have to memorize in the traditional format is just not an efficient way of studying the material, in my opinion. All right. Moving on to our next problem, we're going to be looking at some journal entries springing out of some of the chapter 4 stuff that we're dealing with. And we're told here we need to prepare journal entries for each of the following transactions of a merchandising company. The company we are told uses the Perpetual inventory system. So we see that Perpetual inventory system and the gross method. Now, at least in the version of the book we're using when I'm recording this video, these are the only two things we're going to be using for journal entries, the Perpetual system and the gross method. Now, if we adopt a different book eventually somewhere down the line and we do both perpetual and periodic and we do both gross and net, of course, you'll need to cover that information on your own, or I will announce that in class, of course. But at this time, this is all we're really focused on. And so let's see how this one works. In this case, we purchased 600 units of product at a cost of $10 per unit. Terms of the sale are 2, 10, and 60. Invoice dated November 5th. And you say, well, hold on, what on earth is this 210 net 60? So the 2 in the 210, this means we get a 2% discount. And you say, just always? No, right? That's what the rest of this is about. These are what are called the credit terms, is 210 net 60. So we get a 2% discount. And then here's the key. If we pay within 10 days. If we pay within 10 days. That's the 2/10. 2% discount, so that first number is a percentage of discount. That second number is how many days you have to pay to get that discount. So 2% discount if we pay within 10 days. Otherwise, the net amount, that's the N, the net amount is due in 60 days. So this is a 2-month credit sale, right? We have up to 60 days to pay for this. But if we want to get a discount, we should pay this within 10 days, and that discount is 2%. So we've got 10 days to get a 2% discount. If not, we pay in 60 days. Now, what this means is there are really only 2 acceptable dates for you to pay this bill. So if you think about this for too long, hopefully you'll realize there's nothing to be gained if we pay on, say, day 6. Because if we pay on day 6, are we still getting the 2% discount? Yes, we are. So that's good. But we could have gotten the same discount even if we paid 4 days later. So why pay on day 6? So basically what this means is there's only 2 days you should ever pay this bill. If you want the discount, pay on day 10. If you don't want the discount, or if you're strapped for cash, you need to stay on credit for a little bit longer, that's fine, pay on day 60. Now, what I'm not telling you to do is to pay late, right? Don't pay on day 63. That's late. That's bad. Don't be late. But never pay early unless you're given good reason to do so, because that impacts your own liquidity. And if something were to break down the line 2 weeks later and you needed that money, you don't have it now because you paid too soon. So you want to make sure you take advantage of the credit terms fully. So if you want the discount, pay on day 10. If you don't want the discount, or if you look up and it's day 13 and that bill got lost under something, don't rush and pay it on day 13. There's nothing to be gained. Put it to the side, pay it on day 60. That's how you want to properly manage your cash of your company. Now, in this case, we purchased the 600 units, $10 a unit, terms of the sale, 210/60, invoice dated November 5th. So we're going to come in and we're going to look at what this entry is going to look like. Well, we bought some inventory. So we're going to debit merchandise inventory, or just inventory. And of course, this was on account, so I'm going to credit cash. Is that right? Should I credit cash? Well, no, right? Because this is a credit sale. Anytime you see 210/60, 315/40, 975, whatever, right? Whatever the terms are, it doesn't matter. But once you see some kind of terms like that, those are credit terms. So even though the problem does not specifically say we bought this on credit, we know that we bought it on credit because we have credit terms given to us. So then our credit here must be to accounts payable. Now, the way this works is this is the gross method, which is, like I said, the only one we'll be using, at least at the time of this recording in the class. But what that really means is that we are assuming up front that we are not taking the discount. We're not taking the discount. We're assuming we're going to pay for all of it. And that's why you'll notice the 6,000 is the 600 units times $10 per unit. Now, on November the 7th, we returned 25 defective units from the November 5th purchase and received full credit. Now, here we go. We returned 25 units. So those units that I returned, do we still need to pay for those? I don't think so. What that's going to do, that's actually going to decrease my liability. Right? Accounts payable is a liability that has a normal balance of a credit, which is what we saw in the November 5th entry. But on November 7th, we're actually getting to return some of this because it was not right. When we do that, that lowers the bill on what we have to pay. And in this case, that'll be the 25 units times $10 per unit. That'll be $250. Now there's only 2 accounts here, so we of course know the credit is also $250. And now we just got to figure out what the credit is to. Well, I sent back inventory. So the credit has to be to merchandise inventory. It has to be what the credit is to because I returned my inventory. So my inventory account needed to go down. Now, on November 15th, this is perhaps the trickiest entry of all. We paid the amount due minus the return. Well, if we just look at this in a T account format, so I'm going to go ahead and I'm going to start erasing all this highlighting because it keeps bouncing around the page. And we're going to need to draw some T accounts just to help us visually see what's going on. So I'm just going to come out here in this margin. Well, if we were to do an accounts payable T account, for example, we would know that at the beginning of this, we credited accounts payable for $6,000. Then we debited accounts payable for $250, leaving us a credit balance of $5,750. That's my credit balance. Now, once I pay the bill, this has to go all the way down to 0. So that means I'll need to debit accounts payable for $5,750, leaving me with a 0 balance, which is correct. So let's go ahead and do that. So right here, we're going to go ahead and debit accounts payable $5,750. Common mistake here is debiting accounts payable for $6,000 because we'll get off in this entry somewhere and not debit accounts payable properly. We'll look at our T account. If we drew one, we'll see the 6, we'll do 6 and we'll think we're done. With that part at least, but be careful. Be careful. Now, The next thing that we got to think about is we're paying for this. If we're paying for this, then how do we pay for stuff typically? With cash. Okay, so I got it. I'm going to credit cash for $57.50. Is that right? I want you to think about it for a second. Is that right? Now the answer is no. That would not be correct in this case, because what we find is, remember, we had those credit terms, 2, 10, and 60. If you just go to crediting cash for $57.50, you are paying 100%. But look at the dates. The date of the first entry is November 5th. Next entry is November 15th. This is exactly 10 days. We do get the discount. So what that means is, to figure out the amount of cash we pay, we're going to come over here. We're going to do 5,750 times, and then there's two ways to do this. You can do 100% minus 2%, and that is $5,635. Or, of course, if you realize, you could do 5,750 just times 98%. If you realize that 100% minus 2% is 98, there's no reason to write it out the other way, and you'll still get $5,635. Now, that is the credit to cash. Okay, so we'll go ahead, we'll credit cash for $56.35. And at this point, we're done, right? My debits equal my credits, and we're good to go, except they don't. So because my debits and my credits don't equal, we know we've got a problem. We know there's more work to be done. And now we've got to think, well, this difference, we can tell, is going to be a $115 credit. What account does that need to go to? Oh, I got it. I bet this is it. Purchase discounts. It sounds like such a well-named account, doesn't it? We purchased something, we got a discount. I bet it goes to the purchase discounts account. No, it doesn't. Unfortunately, this is a very common wrong answer on the test, because the test does give you the option, I believe, for a purchase discounts account. But under the perpetual system, that is not how we do this. So what we need to realize is the account that needs to go to. So let's think about what accounts we've got involved in this problem. Now, one of the accounts that we haven't really seen much activity from so far is my inventory account. Now, we were dealing with it at first, but we haven't really talked about it in a while. So if we were to look at our merchandise inventory account, you'll notice we debited that account for $6,000 originally, and then we credited it for $250, giving us a balance of $5,750 in inventory. But what do I have to book my assets at? What principle from chapter 1 applies here? Well, you'll remember we talked about something called the measurement principle, or what we called the historical cost principle in chapter 1. That principle tells us that we record assets or transactions, truthfully, record transactions at cost. Well, what is cost? Recall that cost is the amount we pay. You see what's happening here? Look what let's put this all together. Let's look at what just happened. If I leave my inventory at $57.50, which is where it's at right now, look at how much we actually paid, $56.35. Those two numbers are not the same. This is a violation of the historical cost principle. You are violating a gap principle if you do this. You cannot do this. What that means is that credit needs to actually go to the inventory account. You'll credit inventory for $115. That will then bring your actual inventory account balance down to $56.35, which is equal to the cost. This is properly done and follows GAAP. So now we're going to go ahead, we're going to come in, we're going to credit that merchandise inventory account. for $115. That'll bring that inventory account balance down to $56.35, which is the cost of what we paid. And so now we are good to go. Now we are good to go. Okay, at this point, I'm going to go ahead and clear all of that out. We're going to go ahead and move on to the next problem. Now, the next problem has another picture that I think is very helpful if you will draw it. Once again, if you don't draw the picture, it's probably not going to go super well. But here we go. We're going to go ahead and we're going to look at this picture. It's just a graph. And so what we're going to put here is on the x-axis, we're going to put time. We got time here on the x-axis. And on the y-axis, I'm just going to put money. This price levels is really what that's short for, price levels. So we're going to see what's happening to price levels over time. Now, in real life, we normally see something like this. This is what's called an inflationary environment, where as time marches on, price levels increase. That is what we typically find. And sometimes we don't like inflation, but the alternative to inflation is deflation, which is actually much, much more painful. It's a symbol of the actual economy contracting tightly, which is actually much more painful than normal levels of inflation. Now, if inflation gets too high, it's certainly a problem. But traditional 2 to 3% inflation per year, we typically like to see that. It's typically viewed as a sign of a healthy economy. When it starts getting up extremely high, that can be more problematic. But of course, like anything, extremes are never that good. So we do want to be careful there. But what we find is this is our setup. This is our graph that's going to help us decide what's happening with FIFO and LIFO in various periods of time. Now, you might not get a question that looks exactly like this on the test, where I just give you this and I say draw arrows or something. But you certainly might get some question that if you understand this, it will give you a really nice way to check your work, to check your answer and see if you got something logical. Now, let's think what these two things mean, and let's just write those out. So FIFO means first in, first out, and LIFO means last in, first out. So first in, first out versus last in, first out. So if we're looking at our time as our graph here, if I'm operating under FIFO, then what I can say is, well, if I'm selling the first ones, these are the units I'm selling. These units down here. And what do you notice about the cost associated with the earliest units? It's low. Conversely, with my LIFO, I would be selling these units first, last in, first out. And you'll notice that has a much higher cost associated with it than these units here. So this has a higher cost of goods sold. Now, for gross profit, we think, well, gross profit is sales minus cost of goods sold. Give me gross profit. Well, whether I use FIFO or LIFO, and truthfully, this is net sales, right? This is truthfully net sales. But whether I'm using FIFO or LIFO, that number is not changing. The cost of goods sold is. If I'm subtracting a smaller number, then my gross profit is higher under FIFO. And I'm subtracting a bigger number under LIFO, so this is lower. Net income, well, all we're going to do is continue this down, take out our expenses. And of course, none of these other expenses get affected by this difference. And so then we're going to end up with net income. And I realize that's a bit of a blanket statement. Truthfully, like your income tax expense will be different, but your other expenses won't be. So just as an oversimplification, I'm going to say, I'm going to subtract out expenses, we'll get net income. Well, if this is higher under FIFO, and this is the same under both methods, then net income under FIFO is higher. And then, of course, that means net income under LIFO is lower. And under FIFO, remember, we sold these cheap units first, which means at the end, we have the more expensive units on my balance sheet and inventory. So the higher balance and ending inventory, which means a lower balance and ending inventory for LIFO. There's our setup. That's how this works. And then, of course, If we had a period of declining prices, all you're going to do is flip all of these arrows. This is why I say it's better off if you just learn one direction and then flip everything than really trying to learn both directions. Like I said before, you only have a limited amount of space in your head. You want to maximize your efficiency in learning these things. So learn one direction. And then if you get a question that asks you about the other direction, just flip everything. So under FIFO, that means in a period of declining prices, we would have higher cost of goods sold, lower gross profit, lower net income, and lower ending inventory. And here this would be lower, and then of course higher for all of these. Okay, so that's our setup. That's our setup. Now, that's how FIFO, LIFO relate. That's how they work. And that gets us a pretty good view of this. Notice how easy that is with the picture. You can just identify where am I at on the picture and then answer the question. Okay, I'm at a higher point, I'm at a lower point, whatever it is. But now you look at this and you say, well, okay, typically we're in a period of rising prices. That's just tends to historically be what we find ourselves in real life. And if we look at FIFO, it gives me a lower expense, higher gross profit, higher income, and higher assets on the balance sheet. Why might I choose to go with LIFO? That's the cynic in you say. Why might I choose to go with LIFO? Well, is there a benefit occasionally to reporting a lower net income? And the answer, of course, is yes. There is actually a benefit to reporting lower net income in that along that route, when you incur that higher expense for cost of goods sold, you have that lower gross profit, you're also going to have lower income before taxes. This lower amount for income before taxes will result in you paying less in taxes. So you'll have a lower tax expense. This is one reason you might decide to actually opt for LIFO. But now you say, okay, well, that's great. I can pay less in taxes. I can recognize a lower expense. That's all wonderful and well and good. But what if I were to file my tax return with the IRS using LIFO, and then I turn around and I file my financial reports with a bank using FIFO? Can I have the best of both worlds? And the answer is no. This creates, or out of this is what becomes the LIFO conformity principle. The LIFO conformity principle says basically this, and this is a paraphrasing, this is the idea, that if you use LIFO for income tax reporting, in other words, to get that income tax break, you must also use LIFO for financial reporting. In other words, you're not allowed to get the income tax break on the one hand and then go issue stock at the higher price because you have higher income on the other hand. That's not how this works. If you want the lower taxes, fine. We realize that's one effect of using LIFO under a rising price environment, but you're going to have to settle with that lower net income number whenever you go present to your board or whenever you go make that IPO. Whatever the case is, you're going to have to use the same. So there are a lot of places where your tax and your book treatment can differ, and it's okay. This is not one of them. This is not one of those places. So with that, we are done with this problem, and we are ready to go ahead and move on. Now, for the next problem, we're going to go ahead and look here at perpetual inventory costing with FIFO. So here we go. Our first date we've got is January the 1st. And we see a company reports the following beginning inventory and 2 purchases for the month of January. On January 26th, the company sells 350 units, ending inventory at January 31 is 150. Assume the perpetual inventory system is used to determine the cost assigned to ending inventory when costs are assigned by some Fifo method. So on January the 1st, we didn't purchase anything, we didn't sell anything, but we did have a balance, 320 units at $3 a piece. Gives us a balance of $960. Now, the next thing that we had happen is on January the 9th, we actually purchased some more units. We bought 80 units at $3.20. Now, we didn't sell anything, so that gives us an inventory balance at this point comprised of 2 layers, 320 units at $3, that's our beginning, and then 80 units at $3.20. This gives us a grand total of $1,216, and that is the sum of these two. And that is the sum of those two. Now there's a way to do a little curly brace thing in here. I can't remember where it's at. I think it's, let's see. Don't waste too much time trying to do this. But if I could get one of them, then we would be able to just copy it down for the others. So here we go. This is what I'm looking for. So this is just the sum of those two. The sum of those two. Okay. Let's see. It's been a while since I did this, trying to get that to be a little bit thicker so it's easier to see. Okay, there we go. So it's the sum of those two. And the reason I really wanted to get that right is because we're going to be using that pretty often throughout this problem and the next one. So just to more clearly show what's happening, I wanted to have that on deck and easily accessible for us. So we've got that right there. Now, the next date that we care about is January the 25th. Now, on January the 25th, we came in and we purchased 100 units at $3.34. Now my inventory balance is comprised of 320 units at $3, 80 units at $3.20, and then 100 units at $3.34. Taking the sum of those gives me $1,550. And once again, this is why I wanted that, is now we can just copy and paste that and drag, oops, drag it on down where we need it. And there we go. So now it's clear what's happening here is the sum of those three coming over to here gives us 1,550. Now on January the 26th, the company sells 350 units. So if we just do a little bit of quick math here, we can see that we started with 320, we bought 80, and then we bought 100. 320 and 80 is 400 plus 100 is 500 units. So we've got a total of 500 units available for sale, and we sold 350 of them. But now the question is, on January the 26th, which 350 units did we sell? Well, look at what method we're using. We're using the Fifo method. So first in, first out. So what are my first units? These 320 at $3. But that's not all, right? I sold 350 units, not 320 units. So I need 30 more units. And my solution is I come down to the next layer. So at this point, this layer now has 0 units. But now I need 30 more. So I'll sell 30, which will leave me with 50 units here. So I'll sell 30 at $3.20. And then my inventory balance will be 50 at $3.20 and 100 at $3.34. Now, at this point, we can go ahead. 320 times 3 plus 30 times 3.2 is $1,056. And 3.2 times 50 plus 100 times 3.4 is $494. And you say, well, that's great. I like it. But how do I know that's right? Is there a way I can check myself? And as you know, if there's ever a way that you can easily check yourself, I like to give that to you. And so there is a way you can check yourself. And I strongly recommend that you do this. Anytime you have a sale, on this date we had a sale. If we remember back to our picture from chapter 4, it looked like this. We drew it just a little bit ago in the video at the very beginning, actually. So if you want to go back to it, it was drawn a lot nicer there. I'm just going to draw a very quick rendition of it here. But this is what we saw in about the same area of the screen. And what we said was that at any point in time, my cost of goods available for sale, which in this case was $1,550 right here prior to the sale, has to equal out to what I still have, $494, and what I actually sold, $1,056. Well, 400 plus 1056 is 1456, plus 94 is indeed 1550. 50, these two adding up and coming back to right there is what we should find. If that does not happen, you have a mistake somewhere, right? You've got a typo, you wrote something down wrong. I'm not sure what your problem is exactly because it'll depend on a case-by-case basis, but you can know for sure you do not have this right if anytime you make a sale, you go back up to the line before it and you look at what you had available. If those two numbers, what you sold and what you still have, do not add up to be this, you've not accounted for everything, you have a mistake somewhere. Now, there was truthfully another way that we could have gotten down to this 494 and the 1056 very, very quickly. This is a FIFO question, first in, first out, which means last in, still here. In other words, if I just wanted my ending inventory, what I could have done is said, look, we have a total of 500 units. The first 350 will be sold, which means the last 150 will not be sold. So 100 at 334. Gives me $334. And the last 50 at 3.2 gives me $160, which gives me a grand total here of $494 and 150 units. Then, of course, we could have said, well, I know 320 times 3, 80 times 320, and 100 times 334 is 1550. 1550 minus that is 1056. So we can be done in about 20 to 30 seconds getting the key pieces of information. Now, unfortunately, on a digital exam, like what we have with Connect, I believe it's going to force you into this big table for the worked out part of the test, at least, where you're going to have to do this, even if you know this works. But for a multiple choice question, realizing that FIFO Perpetual and FIFO Periodic always give you the same answer is incredibly, incredibly valuable. And it will save you a tremendous amount of time on the test. So keep that in mind. Now, for the next problem, we're looking at perpetual inventory costing with Lifo. Now, unfortunately, perpetual Lifo and periodic Lifo do not always give the same answer. They don't. In this specific question, they will, I believe. And that's because the only sale occurs after the last purchase, so there's no actual difference. But if you have multiple sales sprinkled throughout this, you will get very different answers based on using Lifo Perpetual or Lifo Periodic. So be very careful in that regard. And I know at least for a long time, I've been doing very good job on the exams of making sure I pick questions or write questions myself that do not give the same answer with Lifo Perpetual or Lifo Periodic. So even though it happens in this one example on the review, don't think that's the way this always works. That's not a good way to go thinking about this. Now, the good news is a lot of this stays the same. So actually what I'm going to do is I'm going to grab all the stuff that stays the same and I'm just going to copy it and paste it. And let's see if we can get that to paste correctly. And it's not going to let me paste that nicely. Okay, no big deal. We'll just rewrite it. I thought we'd try to make the video a little bit shorter by not having me have to sit here and rewrite this, but it is what it is. So these first three rows are not going to change at all because all we're doing is purchasing stuff or taking what we already had. And of course, none of that changes between FIFO and Lifo. The big difference in the two only happens whenever you actually have a sale occur. And that's when we have a problem. That's when we have a difference. So let's go ahead and get all of that in there. And that gives us a grand total, once again, 1550. So at this point, this is just an exact replica of what we did on the previous page. If you're not sure about that, just rewind it and go back and look, take a picture of it. It's the exact same thing. There's been no changes at this point. Now what we're going to find is that on the 26th, we actually made a sale. This is where the change happens, because what we're going to find is instead of selling the first units first, we're selling the last units first. We need to sell a total of 350 units, remember? So we're going to sell the first 100 at 334. Last in, first out. So these are now gone. We now have 0. But have we sold 350 units yet? No, we've only sold 100. So we go up one more row. Well, the next row only has 80 units. That's all we can sell. 80 at 320. So now this row zeroed out. But have we hit 350 units yet? Well, 100 plus 80 is 180. So we still need another 170 units. There's only one layer left, so these better all be coming in at $3. So 170 at 3. This gives us a grand total. When we add all of these 3 pieces up, let's get our line here. And before I give you the number, let's think. What do we expect about this number? Well, let's look what's happening to prices. We're going from 3 to 320 to 334. Prices are going up. We're in a period of rising prices. And based on the problem we did earlier, comparing FIFO and LIFO in a period of rising prices, what should we find about this cost of goods sold relative to the one we just did on the previous page? Well, we're looking here. LIFO, we're selling last in, first out. So if we're looking at our graph, we've got time here on the x-axis, we got dollars or price levels here on the y-axis. We're selling the more expensive goods. This number, whatever it is, should be bigger than 1056. Conversely, our ending inventory number under LIFO should be smaller than 494. So let's see if that is indeed what we get. Now, when I do this and I pop all this in the calculator, I'll come out to $1,100 for cost of goods sold. And my ending inventory now is just 150 units at $3. Or a total, oops, got that in the wrong. Let me move that over. There we go. Or a total of $450. And so what we find is that indeed my inventory balance of 450 under LIFO is less than 494 under FIFO, which makes me think I probably did this right. And I find that my $1,100 cost of goods sold is greater than the 1056 cost of goods sold under FIFO, which makes me think I probably did this right. And so we can see that there is some value in knowing that table, even if the problem doesn't directly ask you that information, it works out. Now, like I said, in this one specific case, because of the way the numbers work out, you can do this, but I strongly advise against doing this at any point on the test because it is not a reliable way of doing this. But I do want to address it head on just in case someone finds this and goes, oh, I bet he didn't want me to find this shortcut. No, it's not that. If there's a shortcut, I am happy to share it with you if it's reliable. This is not a reliable shortcut, but it does work, once again, in this one specific instance. So we'll take the 150 units, multiply by the $3, and that will give us the $450 ending inventory cost. Once again, do not do this on the test. It works in this one specific case, but it will not work most likely on the problem that I pick for your exam or on the problem that I write for your test. So be very, very careful there and realize that if you get a question that asks you to do perpetual FIFO, you can shortcut it by treating it, especially in the multiple choice, as periodic FIFO. FIFO always gives the same answer. LIFO does not. If you get a question in the multiple choice asking you, if there's a multiple choice section, asking you to do LIFO periodic or LIFO perpetual, you better do exactly what it asks you to do, because most of the time you'll end up with different answers. All right, now into chapter 6. Chapter 6, we're looking first at petty cash. Petty cash is one of our two main topics here in chapter 6. So we've got this company, Brooks Agency. They set up a petty cash fund for $150. Now, to be clear, a petty cash fund, what I want you to think of when you're thinking about these types of problems is you got a box. It should be a locked box. One person should have the key. There should be a register or something indicating where the money went, collection of receipts, the cash, the change. All that is locked within this box. At the beginning of the period, this has $150 in it. This is my beginning balance. Now, petty cash is used for small day-to-day activities where you might not want to have to go through the formal requisition process. Someone shows up and they have something they need to deliver. You owe some money for postage. All right, I'll pay for that. The office wants to order a pizza to give everybody lunch. Okay, cool. We'll pay for that out of petty cash. We got to do some small printing job or something else. Okay, we'll do that out of this. It's for very small day-to-day things that people, in the absence of this type of fund, would have to go through a formal requisition process, and it would slow everything down and make the business operate very inefficiently. So petty cash is actually super important, but it's normally a nominal amount, a small nominal amount. In this case, it's $150. For a larger company, it may be $1,000. It may be more than that, right? It's going to certainly depend on the size of the company and their needs, but it's normally an amount that is not a huge deal. But we do still want to make sure it's being properly accounted for. So in this case, we need to first establish the petty cash fund. In the establishment of the fund, this is one of the times we actually get to debit petty cash, and then we will credit cash. We're setting up the fund. Debit petty cash for 150, credit cash for 150. Now in part B, we need to reimburse the fund. So they say, all right, reimburse the fund at the end of the current period, and realize at the end we had 28 bucks in there and we had receipts for these three things. The very first step you should always do when you're working a petty cash problem, the first thing, every time, you need to come in and you need to take the difference in the balance of the petty cash at the beginning of the period minus, so 150 minus the amount of cash that is left. In this case, 28, that'll give you $122. This is the amount of cash that has actually been spent. Now, we may or may not have receipts for that amount, but I know for a fact that that much money has been spent. So I can go ahead and drop in a credit to cash for $122, that difference. And that is the very first thing that I recommend you do on any petty cash problem. If you do anything else, you are far more likely to make a mistake than if you go ahead and anchor that point down. Now, the other three pieces of this are going to be the things that we spent money on. So we have a debit here to entertainment expense. This will be $70. We have a debit here to postage expense. That'll be $30. And we have a debit here to printing expense for $22. Now, luckily in this case, 70 and 30 is 100 and 22 is 122. We balance out, we're good to go. However, if let's say this printing expense had only been for $20, that receipt, this is not right, by the way, don't change this. 22 is correct. But if this had been 20 instead, this would only be 120. In that case, we would have actually spent 122. We've only got receipts supporting 120. You would need to debit cash over and short for $2 to make this thing balance out. Now, in this case, we didn't have to deal with that, but you certainly might have to deal with that on the test. So do be aware. Now, part 2 of this question, identify the 2 events that cause petty cash to be credited in a journal entry. Well, let's go ahead and look at this, and I'll just do this with the highlighter. So we want to credit petty cash. Well, if the fund amount is being reduced, that would certainly be the case of where we would want to credit petty cash. And if the fund is being eliminated, notice that this is the same thing as being reduced. This is just reduced to 0, where this is just being reduced to say $100 or $150 or $120, depending on the problem. And so both of those actions would result in a credit to petty cash. The other two, the fund amount being increased, you would actually debit petty cash, and the fund being established, once again, is a debit to petty cash. So it's A and C for number 2, part 2. So A and C. And at this point, we'll go ahead, we'll clear everything out. And now we've got a bank reconciliation problem. In my opinion, this is a far more challenging type of bank reconciliation problem than doing an actual bank reconciliation. Because with the actual bank reconciliation, if you're not sure about one of them, you can just put it somewhere and see if you balance. If you don't balance, you know you're not right. Unfortunately, with this, there is no way to check like that. So you really just have to know what's happening here. Now, the rule that I want you to use, and if you have me in class, you've heard this rule over and over and over, is when you are preparing a bank reconciliation or a bank rec, ask the question, Who does not already know about this? That is the side that needs a correction, or that needs to do something with this information. Because if you already know about this, whatever this is, then you're good. You've already presumably accounted for this. If you're not aware of this, you haven't done anything with it, so you have to make that correction. Now, here we go. For A through G, indicate whether the amount 1 affects the bank or book side of the bank reconciliation, 2 is an addition or a subtraction, and 3 requires an adjusting entry. So letter A, interest earned on the cash balance. Does the bank know they paid you interest? Well, I would hope so. If they don't, we've got some serious internal control issues at the bank. So the bank knows about this. Who does not? The book, the company does not know about this. So it's an adjustment on the book side that will be added. Now, what I'm going to do is I'm just going to do these first 2 columns first. Then at the end, I'll show you a trick to get that 3rd column, and we'll do it all at once. So we'll do the first 2 columns all the way through. Then we'll fill out the 3rd column, identifying if we need to make an adjusting entry or not, all at the same time. Letter B, bank service charges. Does the bank know they charged you something? Once again, I certainly hope so. So the book has an adjustment, but this will be a subtraction. This will be a subtraction. Now, for letter C, we've got a minimum balance bank fee. Does the bank know they charged you something? Absolutely. So this is a book adjustment, and this will result in a subtraction. Letter D, outstanding checks. Now, what do we say about outstanding checks? These are checks that are doing a great job at being checks, right? They are outstanding. Is that what this is? No, of course not, right? What an outstanding check is something that you've written, but it hasn't been cashed yet. So this is why, let's say your grandmother writes you a $10 check for your birthday, and your birthday is today, and tomorrow is the end of the month, right? Well, you didn't get to the bank by tomorrow because you were busy and you thought, well, I'll go next week. Well, when her bank statement gets cut, the bank will not know that this check has been written. So it's going to come in and her bank balance is not going to match her checkbook register. And you're going to get a mean phone call from grandma saying, what, you don't care about my check? You don't value that money? It's not that, right? It's that you just haven't had a chance to go yet. And so you say, no, it's not a big deal. I'll go tomorrow, right? Well, the reason this is off is because that check is outstanding. At the end of the period, the bank has no knowledge that the check has been written. So who needs to make the adjustment? The bank needs to make the adjustment. And when we make that adjustment to the bank side, this will be a subtraction. Now, letter E, collection of note by the bank. Someone paid the bank on our behalf. Does the bank know they collected that money? Yes. Who doesn't know? The book. The book does not know, so the book will make an adjustment, and we will add that to our book balance. Letter F, Nsf check. What is an Nsf check? That's a non-sufficient funds check. A non-sufficient funds check. So NSF means someone wrote you a check, you thought it would clear, so you put it into your account on your side. They went to the bank, or you went to the bank, and the bank said, nah, that check doesn't work, right? They don't have enough funds in their account. The check bounces. So we call it a bounced check or a hot check. So the bank never even put this in your account at all. So the bank definitely doesn't do anything, but we included this in our balance in our register. So we need to make an adjustment on the book side, and that adjustment will be a subtraction. And now letter G, outstanding deposits. This is typically viewed as the night drop, right? So you go to the bank, you want to put money in the night drop. Now, what I will caution you about is the night deposit should be connected to the interior of the bank. It should be in some type of vault that has strict internal controls and only is accessed by typically a time lock at certain points in the day. It's extremely secure and connected to the main building. This is not a cardboard box sat outside the bank with the words night drop written on it. This is not anything that's detached from the bank or in any other way not connected. If it is not connected to the bank, it is not a true night deposit. It is some scam that someone's trying to steal your money. Be very careful. What we find is that whoever took these checks to the bank knows that we've taken these to the bank. So I put the money in the night drop at the end of the day on the last day of the month, and I include that in my bank and my balance in my register. But the bank already cut the statement for the day. The bank won't know about that deposit until the next day. So the bank side of my adjustment will need to be corrected. And when that happens, this will result in an addition to the bank side. Now, what we want to see is, when do we actually make those adjusting entries, and when do we not make those adjusting entries? Now, the question here really is, who do we work for? We work for the book. Anytime there's a book adjustment, we will need to make an adjusting entry. If there's a bank adjustment, the bank, they can make their own entries. We don't work for the bank. So what this means is that for the first 3 entries, we'll say AJE is required. Is required. And we'll skip the 4th one. And for the next 2, E and F, that will also require adjusting entries. But D and G, we will say no adjusting journal entry is required. No adjusting journal entry is required. And that's because we don't work for the bank. We work for the book. We work for the book. Now, I'm not going to go over what those adjusting entries would be, because I don't think I have you doing those on the test. And I feel like this video is already very long at this point. So we're going to go ahead and cut it here. But as always, if you ever have any questions, let me know. I'll be happy to sit down with you and try to help you get caught up and get this all figured out. I know some of this material is dense and it's kind of strange for a lot of us if we're not people that love accounting. But hopefully we're getting through the course okay at this point. And like I say, if you ever do have questions, send me an email, come by my office. I'm always happy to sit with you and help you get caught up. Thank you so much and have a great day.